Financial Reporting and Analysis, video number 10. Introduction. We will study about credit risk, security selection, backtesting, and investor types. Credit risk is the risk of loss caused by failure to make the promised payment, and credit analysis is the evaluation of this credit risk. Screening is the application of a selection of some criteria to reduce potential investments to only the best. Security selection may use a top-bottom approach or a bottom-up approach. A top-down approach analysis using macroeconomic conditions and geographical segments involves looking big, looking macro, looking at the whole economy. A bottom-up analysis uses specific micro-investment selections from all companies within the investment portfolio. Backtesting evaluates an investment process by applying it to historical data to see how it would have performed. For example, creating a method to earn more profit today in Forex, but before risking our money today, we apply it to year 1990 to see how it would have performed. Backtesting has three main limitations. Survivorship bias. Database may only include best companies who have survived. Look-ahead bias. If financial statements are updated and changed to correct the error, then at the time of first issue, we do not know the real error. Data snooping bias. Testing a model on the basis of previous findings should be tested by only using future data. Investor types. We have growth investors who invest in high-earning growth companies. We have value investors who invest in low share values relative to earnings. And we have market-oriented investors. It's simply using both growth investor strategy and value investor strategy relative to the market. Thank you and have a blessed day from rank1international.com.